Right. So we have topic 4 today to discuss. And the title of the topic is International Financial Markets. Uh, Whenever you want to finance the new venture in the global market, then your choice is not restricted to the local financial market only. You go beyond it. You can borrow in different currencies. You can borrow in different markets, in different countries from different banks, thanks to financial liberalization and financial integration. That it's not so complicated as it used to be in the 1980s or before that. The borrowing from a foreign banks, borrowing in a international currency wasn't easy that time. But now things are so smooth and straightforward that the younger generation doesn't even realize that it used to be a big problem once upon a time. So financing new ventures or expanding a new venture, whether you want to expand in the domestic market or in the foreign market, you can still look for the international financial market. So even if you are a small Finnish company and you want to open a subsidiary in Finland alone, no imports, no exports, about financing, you can still look at the international financial markets. Okay. And many times, if you are an already established company and you have a brand, you are well known, and you want to start some new operations in a new country, then you prefer not to transfer funds from the home country, but rather get the funding from the host country. So for example, if a Finnish company wants to start its subsidiary in Malaysia, so rather than moving funds from Finland to Malaysia, it would prefer getting financing from some Malaysian market only or nearby market, because then if you're in Malaysia, then Singapore is a very famous, very well-established financial markets. Not far away is Hong Kong. So you can, rather looking at the European finance, you can start looking at the Asian finance. And similarly, if you are moving to West Asia, then Dubai, Sharjah, all these well-established financial markets are available there. So you don't feel the need to move the money from your home country to the host country. Host means where you are going to start the new operations. So therefore, understanding of the financial markets when it comes to new ventures altogether or expanding the existing ventures in the context of global markets, the international financial markets are very much relevant. If you don't consider them, then maybe you end up having a higher weighted average cost of capital, which was the last assignment. So you rather look at the cheaper but reliable source of funding. So that's the topic is about. Most of the reasoning I have explained to you, but we can still read a few of them to understand different types of exchange rate system. It's very important that you understand how the exchange rate mechanism works, because still in different countries, how the exchange rates are determined, even though it's getting more and more homogeneous, but still some local touch, diversity, difference is still there. So it's very important to know for a student of finance that how in the global markets, the exchange rates are determined. Yeah. Yes, this is something second, how it progressed, but it's not my main objective. How the central bank intervene. I will not say interfere, but how they intervene. Interfere to me has a bad connotation, but I always consider this interference by the central banks as an important rule to discipline the financial markets. Otherwise, it will become free for all. There's no rule, there's no discipline. So the central banks of the countries play as a referee, and the corporates are the players. Somebody has to be the referee, otherwise you can imagine. to understand the nature and the purposes, the purpose of various types of international financial market. That's very important for you, especially if you are looking at the global markets. If there is any possibility of political pressure or any negative interferences, yes. And then overall thinking and developing the overall rationality about the financial markets. Why do we use the international financial markets? For many purposes. For many purposes, we use it. You can have different role in the international financial markets. If you are an investor, then you may take the advantage of favorable economic conditions, and you can see that, can you even invest? Can you even invest properly? And one potential option to invest is in the currencies. You see, when you're a company, and let's say you are making furniture, your main investment, your real investment would be in the furniture. I mean, the assets, machine, building, factory type of settings. But at some stage, you also want to think, because you know what, when you are having this so-called corporate finance manager in your company, this guy would be very much interested in earning more on top of your main core business. So if you have some saving, he would be very angry if you keep that money in the bank, which has a 1% rate of interest or maybe 0.5% rate of interest, and the rate of inflation is 2%. So basically, even though your nominal value of the money is growing, but the real money is shrinking, and you don't even realize it. So therefore, the professional manager, they think not that they are very maverick, they are very brave, they want to, they're very flamboyant. No, there's a reasoning for it. And the same reasoning I told you, that if the rate of interest the banks are giving you on your saving is so low that you think that actually, let alone the money multiplication, I'm losing money over time. So then they start looking at some better option. And the one option is that you can invest in the currencies. And this investment doesn't take any extra efforts. If you already have your operations, synergies, alliances with the companies overseas, because then you definitely have a bank account there already. So things become much more easier for you. But sometimes, now I would say that some brave heart managers, they can even invest in the currencies, which their forecast is very favorable, even though you are not dealing with them, you're not dealing into them about your main core businesses, right? But we will study it. So that's one thing. The creditors, you think that if I keep, because as I said that thanks to financial liberalization and integration, you don't need to keep, if you're living in Finland and you have some saving, you don't have to save, number one, in euros. You can save in dollars, in pounds, Swiss franc, you name it. And again, you don't have to deposit the money. You don't have to keep your savings only in Finland. You can deposit in the foreign banks as well. And then thirdly, when you are a borrower, so if you are in Finland and you want to start some new venture and you think that maybe you can get a better deal from a global bank elsewhere than the local banks, then why not go for the global banks? Yeah. And secondly, if you are a public company, you can be a small company, but still a public listed company. Let's say you are listed in Helsinki Stock Exchange and you are going to borrow the money. You may even bypass banks. And you can, like your equity shares, you can even issue the debt papers, in the global markets. And we use the phrase for this, CP. They're called commercial papers or corporate papers, right? So we use the phrase CP, commercial papers or corporate papers. If these borrowings are for less than a year, then we call them bill. And if this borrowing is more than for a year, then we call it bond, not James Bond, but corporate bonds. See the point? So I think at some stage we had discussion that the state treasury is borrowing on behalf of the country, the government, from people. We call them as treasury bills and treasury bonds. So we use the prefix treasury if state is borrowing. Treasury. And again, if the state is borrowing for the short period, we use the phrase bill. And if it is for the long period, means 365 days and above, then we use the phrase treasury bond. Similarly, the companies can also borrow for the short period, means bill, long period means bond, but then they can't use the prefix treasury. They can use the prefix corporate, CPs. So in the modern world, your borrowing options are not just restricted to traditional banks. You can go beyond, and you can borrow from the public as well. No worries. And again, if you are a Finnish company and you want to borrow and you want to go to public, you don't have to go to the Finnish public alone. You can go to the global public as well. A little bit about the exchange rate system. We start from the basics, and I'm reading out the definition of the exchange rate. An exchange rate measures the value of one currency in units of another currency. So this represents basically the rate of exchange. So the exchange rate is rate of exchange. So what a simple definition. And you can see here that we have this fictitious example, $1 Canadian, $1.22. So here, though it looks very simple, but it can be very complicated. I'll tell you why. This is the price of $1, $1 American dollar, US dollar, which is paid in Canadian dollars. Here, your key currency is dollar, American dollar, but the reference is given in Canadian dollar. So next time, if I want to write the price of $1, I can even write it in, how can I have the symbols? Okay, I can call it GBP. GBP, Great Britain pound, let's say 87. So in this example, your reference currency changes to British pound, the pound sterling. The unit with one should be of foreign currency. And the number of units on the right side should be in the domestic currency. Now I realize why. Because if it is not a pound, but chocolate, and you want to buy chocolate in Finland, in Jyväskylä, would you pay them in pounds or in euros? No, you are in Jyväskylä and you want to buy chocolate.
Oh yeah.
Yeah.
I thought that we're buying from England.
No. You are in Finland and you want to buy chocolate. Let's not call it pound. Let's call it chocolate. So if you want to buy chocolate, would you make a payment in euros or in pounds? Even though the chocolate could be imported. If you're buying in Finland, you're paying in euros. And if we say that there's no friction, and let's say if Finland is exporting chocolates to Britain, right? And we assume that the prices are comparable, then you pay how much? 80 pence. 80 pence you pay, but you pay pence in where? In Britain. So that's one way of looking. So I'm sorry, I think I said wrong. The currency with one unit should always be a foreign currency. And the one on the right hand side should always be the domestic currency. Only then you are on track. Otherwise, it can be a big error. So disclaimer, what I said previously was wrong. What I'm saying right now is correct. I just realized that this is the right way of writing the exchange rate. That on the right-hand side, with some numbers, 1 point, whatever, should be the domestic currency. And one with strictly one number on the left side should be the foreign currency. I would have continued this mistake had I not realized the example that which my teacher used to give me, that if you are, this is the way the exchange rate should be expressed, and this is the way exchange rate should not be expressed. Based on where you are, based on, look, this is indirect quote in EU, but this is a direct quote where? In England. Well said. So therefore, you need to be careful where you are. So the place of your job is very important. For instance, as I said, I would have continued with this mistake had I not realized the example. My teacher used to say that if you are working in New York Stock Exchange or in London Stock Exchange or financial markets, let's say, then the exchange rates are published like this. So this is the way often exchange rates are published in London Stock Exchange, or this is the way the exchange rates are published in the New York financial markets. If you look, these are indirect quote from the British and the American point of view. You see my point? So for example, often you see that in the British financial markets, you can see, for example, $1 is equal to, pound 1 is equal to euro 1.25. And let's say in American markets, $1 could be equal to Canadian dollar, let's say 1.10. You are highly likely to make a mistake, because in Britain and in America, in the US, often in the financial media, the rates are published indirectly. So then you have to be very careful that how to change them, how to modify them to the direct quotes. Because if based on this exchange rate, you make calculations and your consolidated statements are in pounds, you are making a big mistake. And on the other hand, if you are in the US and your performance is measured in American dollars, then you are using this way of writing exchange rates, you are making a big mistake. The question is that if this mistake is so obvious, why these rates are published like this in the British markets and in the American markets? It is because the pound is so important that they don't want to write it in terms of some other country's currency. They take pride that it's always pound 1 and all other are the reference currencies. Who take this pride? Because most of the financial markets are dominated in pound and in the US dollar. US dollar primarily, and then followed by British pound. Therefore, very often you may be in a situation, the problem becomes even more complicated. If you're a trainee, finance intern, and you are working in London and you're using this exchange rate, this can be a big mistake. So the rates are published like this, but then you become smart enough and make sure that you write it like this. So if I just divide 1 by 1.25, it comes to be 0.80. And if you have the same position in some, let's say, American markets, the US market, then it should be Canadian dollar equal to 1 divided by 110. It should be, let's say, 0.99 or whatever, 91, whatever it is. This is the right way to write it. Does it make sense? So therefore, as I said before, that these exchange rates could be super complicated. And the example is so glaring that I made a mistake. Is it fine now? You understand? So one mantra you listen or understand that if you want to check the right or wrong way of exchange rate, make sure that you identify where you are. Well, I'm making calculation, or I'm measuring my profits and losses in euro. Then on the left side with 1 unit should be a foreign currency. And then on the right side should be the calculation done in euros. Then you are on board. Then it's fine. Yeah, make sense? Little bit of discussion about how these exchange rates are determined. The first theory is a fixed exchange rate. The second is freely floating. Third is managed floating. And the fourth one is very interesting theory called pegged exchange rate system. So because it's so interesting that I put some sign of exclamations. The fixed exchange rate system, I would say that it's almost abandoned in the world. There might be one or two, some tiny mini examples where this exchange rate system is still followed. But otherwise, this system no longer exists. But one good thing about this system used to be that it was very stable. It would never lead to those erratic fluctuations that we see often in the financial world. It's very stable. But the major pitfall of this system is that the state has to interfere too much. If you're a private player, of course, the business world is more in the private hands. You don't like the state's intervention every moment. And secondly, there's a limit to the growth in the foreign exchange. And we are living in the dynamic world. The trades are growing, the commerce are growing, transactions are not only growing, but they're getting more complicated, more complex. And this system is not capable to accept those changes. So all the disruptions that we are seeing these days, this system is not, but it's worth studying that what was so good about it. The good was that the government or the central bank, usually the central bank on behalf of the government, they would have some gold assets. And then they would determine the value of gold, the value of the local currency in terms of gold. And based on that, they would issue the currency. So for example, in a very strict situation, let's say there is 100 million, let's say, this is the worth. This is the gold which, let's say, the Bank of England has. I'm just imagining. Then they will declare the value that I don't know what's the smallest unit of gold. Sorry? Is it ounce or something?
Yes.
Maybe 1 ounce is equal to, let's say, 10 GBP. I'm just imagining. It means that the maximum amount of pound that Bank of England can issue is 10 million GBP. Why? Because the value of the pound, the value of the gold which you have in your treasure is 100 million worth gold. And if 1 ounce of gold, 1 ounce of gold is equal to, I'm just imagining, 10 British pounds, it means that if you want to purchase all the 100 million, you have to pay, so it's 10 times. So the gold amount is 10 times. So therefore, no, did I say opposite? So yeah, so it has to be with 10 GBP, with 10 British pounds. Yeah, so it has to be then 10 times more. So if the gold is worth 100 million GBP, then the amount of GBP which the country can issue would be 1,000, because it's 10 times more. The price, based on the price, yeah. Sorry? The stock market? No. First, it starts with the exchange rate, and then it may reflect on the stock prices. But the starting point of ignition is the exchange rate. Yeah. Then it would affect the interest rates, and then the interest rates can have an effect on the stock prices. Yeah. The stock prices, yeah, the commodity prices. Yeah, exactly. So it means that the maximum amount of British pounds which the Bank of England can issue is 1,000 million GBP. Not a single extra note. They can issue less, but not more. To issue more, they have to increase the quantity of the amount of the value of the gold which they have in their treasury. Yes, Daniel, you have something?
I guess like if we're measuring 100 million, not GBP, but maybe like 100 million of ounces of gold, maybe?
Something, yeah, something like this. So if the 100 million, how to say it? Should I say ounces? Ounces, yeah, well, let's say 100 million ounces, yeah. 100 million ounces of gold with Bank of England, and 1 ounce is equal to 10 GBP, then the maximum amount of GBP that the Bank of England can issue is 1,000 million of GBP. Not more than this. So the problem with this is that this is rigid. If we live in very old-fashioned world where the exchange, the global trade is not growing very fast, there's no exchange, foreign exchange liberalization, business liberalization, economic liberalization, then this work, but this doesn't work. And moreover, there's another problem. This exchange rate system would always block the progress of the poor countries and the developing countries. Why? Because historically, they don't have much gold. They can't have much gold means they can't issue more currency. It means that the trade and the commerce, the size of their economy would always remain restricted. And then they have to depend upon the help and the aid and the other countries, you know, the IMF, all that stuff. That would make some political issues as well. Yeah. Now, the gold standard has also improved over time. What I'm saying is a very strict situation. Slowly, what they did when this realization came that, hey, there's a limit to issuing of currency. Then they said, okay, we don't make it 1-to-1 basis, we make it 75% basis. Which means that to issue 1,000 million GBP in a country, you don't have to keep 100 million ounces of gold. You can keep it 75 million ounces of gold. So that there's still 25 million ounces missing. It means that is where the country has a freedom to issue extra currency without having any backup, without having any security. Ultimately, even this was liberalized. And then try to understand this. I'm talking about the time period between the First World War and the Second World War. 75% becomes 60%. Some countries following 70, some are following 60. Trade wars, a lot of things, and ultimately, after Second World War, it was said, goodbye, not anymore. There were some efforts to revive this strict gold system soon after Second World War, but it failed miserably. And then the people, then those wiser people, when they sat together and they were trying to, come out of this loss and all this devastation, they decided that, what, we have to finally, we can't revive it. It's not possible. Okay. And as this percentage was going down, 75, 60, 50, then they also found that, because then again, they were thinking that, hey, you know what? Look, my guess is that if you look at the way the trade and commerce has grown in the last century, it was about, on average, the world economy grew at between 2 to 3%. If you iron out some of the fluctuations, then the average growth rate in the last century, I'm not talking about this 21st century, I'm talking about the 20th century. If you look at the 80s and 90s, the global economy grew at between 2 to 3% per annum. But if you look at the gold supply in the world, if I'm not exaggerating the numbers, it has been some 0.0001% a year.
Percent.
Yeah. The gold is so limited. We all know, and that is why it has a value. You see, why gold is valuable? Because of its scarcity. If it's not scarce, the value will go down. Tell me something. When a person is dying on the deathbed, does he need water if he's dying of thirst, or gold? Mm-hmm. Water, of course.
Gold if he wants to die happy, I mean.
No, not. I'm talking about survival.
Okay, sorry.
I'm talking about survival. If somebody is driving a car in the deserts of Sahara, and the person is lost, and the person has just shopped from Dubai some boxes full of gold, and they are in the car boot, and now the car is stuck in the sand, and the temperature is soaring to 55 something, and suddenly you realize that there's no water in the car. What would you need the most? Some rescue with and the team come, and the first thing they give you is the water, not gold. So this is what we have in economics: the value in exchange and the value in use. The water may be having higher value in use, but the exchange value is more of gold because of scarcity. Does it make sense? Okay. So slowly this system came down. It was going to cripple anymore. And then, as I said, the reason I raised this discussion was that slowly they were making it from 100 to 90 to 80 to 70 and so on and so forth. And then they were finding out The reason I gave the example of production of gold in the world. Then they start replacing the gold with US dollars and other, let's say, the state securities.
Was it ever the US dollar actually related to oil barrel?
You mean the oil prices?
Yes.
The oil prices in the global markets are still quoted in American dollars.
So the oil is quoted in American dollars, but the US dollar has never been connected to oil as it has been with the gold.
No, because all the oil supply, if you see the major stock exchanges of commodity stock exchanges like Brent, it's always quoted in the US dollar. So all the major, these expensive metals or the strategic metals like gold, like oil, in most of the renowned exchanges, commodity exchanges, they're always quoted in the US dollar till now. Thanks to the strategic power of USA, you know, and so is the American dollar. Yeah.
Ask you a question. If, for example, they have 75% of the reserve, how they can cover this like leftover 25%?
With the American dollar? So yeah, so if you have 100 pounds in circulation and the gold is worth 75 pounds in your treasury, then the Bank of England can also issue extra money. The gap could be filled by American dollars or some state, what's called them, the state papers.
Well, that's inflation.
Huh?
What is inflation?
Yeah, that's the point. That's my starting point, was that the beauty of the gold standard was that it was stable. When I say stable, it means less inflationary. The values, the prices don't fluctuate so much. But the problem is that this system requires a lot of discipline, lots of discipline. And we think that these people are wise, but they may not be wise enough to manage these standards. And also we need to learn the history, that if the gold standard would have been maybe made some more innovations in the peacetime, things would have been different. Unfortunately, the gold standard was more prevalent when the world was very unpeaceful. I mean, the World War I, just before the World War I, and during the time the World War II, and then soon after World War II, that was a time when there was more debate, more discussion was going on about the gold standard. People didn't even think that there can be some other standard than the gold standard. Even though the notes were in circulation, the paper notes were in circulation, but they were fully backed or largely backed by the gold. But eventually this backup, I haven't told you a story yet, that even before, I'm talking about the ancient times, you would have the gold coins. So you can melt them and make them as a gold metal. So you can treat, if you have a pound, the pound face value is a pound, and inside the pound, there's a gold worth 1 pound. So you can use the coin, the currency, as a currency or a commodity, same time. But I didn't tell that because I didn't want to go back so much historically. So that's why I started discussion from the early 20th century. When the gold was not in circulation, there were paper notes, definitely, but they were fully backed by the gold. Slowly this backup became loose, and there were some other things came in, like American dollars, because remember, that was a time America, the US economy was growing and it was becoming more corporatized. And that was the early part of 20th century when the USA was emerging as a superpower in economic sense and also in the military sense. So that was a time when, the might is the right, what do you say? If you're strong enough, then you can bend the rules and whatever. Yeah. So that is something I want to tell you about this. And you can see that the pros is that it maintains stability. It's more greater certainty for exports and imports. Why certainty? Because if you sell something today, you may get the money after a year. And if there's no stability in the financial markets, then the exchange rate can be anything. And that is what we're going to discuss in the post-lunch session, that how you can manage this risk. As Daniil said, the gold standard, because you can't issue any amount of currencies. You have to be disciplined. Therefore, it maintains low interest, low inflation, which is very much a stimulant for the trade and investment. All businesses want is a stability. They are very much, the most peaceful community in this world are the business people, because that is when the business would grow, the peacetime. Otherwise, it will not. And then there was also one more problem. There were lots of pressure coming up on the US dollar. And that was a time when the US economy made major economic mistakes. And that led to the global recession during 70s. I tell you something, why the American dollar was getting more pressure. If I show you, yeah. But before that, US dollar was getting more and more predominant in circulation. And a stage came that the countries can't maintain so much amount of gold. So they have to have some substitute of gold. So that substitute, the definition of that substitute would be that rare, expensive, valuable, strong. And there was nothing at that time stronger than the American dollar. So much so that there was more American dollars outside the USA than in the US. So you see the situation? People were crazy to have American dollars. And the European banks, the West Asian banks, the Asian banks, they were full of American dollars rather than their own domestic currencies, because they were not valuing their own currency so much. They were so much obsessed with the American dollar. And ultimately what happened? The American, the economists, the planners, they realized that, hey, where are our dollars? We are issuing, where did they disappear? Oh, they're in Dubai. And then ultimately they have to issue more. And stage came that there was a lot of inflation. So that caused, sometime your success is your biggest enemy. So on the one hand, the American economy was becoming more successful, more in the limelight. Everybody wants to, American dreams and all that stuff we talk about, even to the extent of the music, you see. But on the other hand, America has to pay the price for it. And the price was it was becoming too much of the global pressure, both economic, and also then we also see that there is a political pressure as well. So there was more responsibilities which the USA has to shoulder. And more responsibility doesn't mean that you will perform it more responsibly. So that caused too much of pressure on the US, and that led to a lot of American economic problems, yeah. So this is a little bit of history about the gold standard. So if somebody ever talk about stability or low inflation, then you should also be careful that it would hinder the trade, progress as well, that we can't grow the way we are growing now.
We already did more than 50 years, maybe. Future.
Huh?
There will be an alternative of dollar.
Yeah, it's already there now. It's already there. It's already there. In fact, when we talk about the second theory, the second point, this actually takes into account this thing here. So we move from one extreme to the other extreme. Sorry. And the other extreme is that we have the free floating exchange rate system, in which everything is determined by the market forces of demand and supply. Basically, this market forces of demand and supply make all the planning and everything redundant. Those who are extreme proponents of this type of free market economy, they say that, hey, you know what? Don't worry, you don't need to have any planner. The market would correct itself. Market have a self-built correction mechanism, self-correction mechanism. You make a mistake, you correct by yourself. Example, let me show you. Yeah. Let's say at the moment, a pound is equal to American dollar 1.20. I'm sure you have seen this picture. Demand curve for pound, supply curve of pound. And here, because dollar are on the right hand side, so it's a direct quote from which country's point of view? From the US point of view. Because the foreign currency is always written as a one unit on the left side. Okay, so it means that here we are talking from the US point of view. So here we see the price of pound, but in terms of the US dollar. Demand for pound, why would people demand pounds in the USA? Well, the one obvious reason is that they want to buy something. They want to buy something from Britain. What would they buy? They would buy commodities and service, or they would travel, or they're planning to invest in let's say some American, they want to invest in some new airport, new terminal of Heathrow, for example. So that is why what they need is pound. Supply of pounds to the US, where do they come from? Well, they come in the form of exports. And similarly, they come in the form of the British people investing in. So they are bringing pounds to the US. The equilibrium is same as we find the equilibrium of a chocolate, which is the demand curve and supply curve. They match, they meet. This much is the quantity of the foreign exchange, and this is the price. This is the price of 1 pound, 1.20. Just imagine, this is strictly when there is free market mechanism is in action, right? You see my point? Just imagine that there is some error and the price jumps to 1.40. The price jumps to 1.40. Tell me something. When the price of a pound jumped from 1.20 USD to 1.40 USD, which currency has become stronger and which has become weaker? Who is weakening and who is gaining strength? Yes, Ivan.
The left has become stronger and the pound has become weaker.
No, it's opposite. So you should pay 1.20 USD to buy a pound. But then the problem, some disruption happens. The market, the world is never perfect. There's some imperfections. Maybe supply of pound to Britain, the supply of pound to America is halted for some reasons. Maybe there is some software breakdown, the money is not getting transferred. There are some short-term glitches. And as a result, there is some disruption in the market and the price jumps to 1.40. And guess what happens? When the price jumps to 1.40, the demand is this much, but supply is this much. What happens when supply is more than demand? The price goes down. Was any monetary authority to bring this price down? No, there was no central bank. There was, but it was not in action. It's a market, because if in the market, supply is this much and demand is this much, the price pressure is downwards. So automatically, what I'm trying to advocate here is that in the free market system, you don't even need the planners. In the extreme free market, you don't need these economists who are the Harvard educated or whatever, you know. Exactly. Yeah, but then, yes, that you're right. The example is very appropriate here. And then what happens? The price goes down until you reach a stage when the demand becomes equal to supply. And here again, no regulator is required. On the opposite side, if somehow it happened that the price is actually 1.10, the price should be 1.20. The price is 1.10. Like, for example, I can even give the example that there is in the Keskusta, there's one shirt. The fair price of this shirt, which is in fashion, is 50 euros. And suddenly you realize that it's selling cheaper. What would people do? They would run. And the same thing happens here. The price should be 1.20, but the price is 110. And you can see here that supply is this much and demand is this much. When demand is more, supply is less, what happens? The price goes up. The market has let this price go up, not any institution. Market itself is an institution. And this is what we always go back to the history. Have you heard this name, Adam Smith? His famous book, Wealth of Nations. Yeah, and he calls it invisible hand. So there is an invisible hand in the market which is doing all the natural justice. Whenever there's a disequilibria, this invisible hand comes in the picture, not the prime minister, not the finance minister, not the visible people, not the central bank of the country, not the IMF, not the World Bank. This invisible hand comes in the picture, in the frame, and sets it right. So this is the extreme case where we have the free market mechanism. I want to discuss a little bit about the phraseology that we were discussing. When you said that when the price jumped from 1.20 to 1.40, who becomes stronger and who becomes weaker? Huh? Try once again.
Pound has become stronger and dollar has become weaker.
Yeah, because now earlier you could buy a pound with 1.20, but now you have to pay 1.40 to buy a pound. Yeah, makes sense? So pound has become expensive and dollar has become comparatively cheaper. Look, whenever the exchange rate, one currency becomes stronger, the other becomes automatically weaker. So what is getting stronger in this example is the pound, and what is getting weaker in this example is the American dollar. Just to add to your vocabulary, maybe you know it. When you use the phrase stronger, it means appreciation. So stronger means, so pound in this example appreciates or appreciation. And who become weaker? Dollar. So dollar is depreciation. Depreciation. So when the value of the currencies goes up and down, there is a phrase called appreciation and depreciation. Just to confuse you more. Have you heard the phrase devaluation? The currency is devalued. Then what is that?
The exchange rate is strict.
When the state decides it, when the state decides, just imagine, I'm making this example a little bit more frantic. Price went from 1.20 a pound to 1.40, 1.60, 1.80. And now the American authorities, they have a reason to wake up and be scared. What is going on? Our dollar is depreciating and the pound is appreciating limitlessly. Then they jump in the picture and say, hey, enough is enough. Now we take over the market, basically. It's like an economic and financial emergency. I'm sure you heard the phrase emergency, that when there's some crisis and then you say, hey, forget about this issue. Now we take control over it. So if they declare the price, that would be called devaluation or revaluation. Devaluation, when the state decides that we don't care about what is going on in the market, like in this picture, we decide that from tomorrow onwards, the price of our local currency, let's say there is some economic crisis in Britain, and the British Prime Minister or the Finance Minister make a declaration that, you know what, from tomorrow onwards, the price of British pound will go down by 10%. Will go down by 10%, and that price would remain stable unless we make any change. So then you don't care about the market. You decide to buy the price, the exchange rate. But if they decide to put it down, then it's called devaluation. Yeah. But if they decide to push it up, that hey, from tomorrow onwards, we decided that the British pound's price value exchange rate would be 10% up against that currency, then the opposite of devaluation would be revaluation. But whether devaluation or revaluation, devaluation is comparable to depreciation, revaluation is comparable to appreciation. But the difference is that the depreciation and the appreciation takes place by the market mechanism, whereas the revaluation and devaluation is at the dictate of the state. And state doesn't dictate every day. In fact, the state must not, otherwise there would be so many political repercussions. So, but in the rarest of the rare cases, the state can jump in the discussion and say, you know what, enough is enough. They can make some minor interference, a little bit, yeah, which I will discuss in the next managed exchange rate. They can make some more regular interactions, not interference, but the interactions with the market. But if those interactions do not serve any purpose and there's a big economic crisis, then they have to come in the picture. I don't know many countries, but the last time I was in India at that time, there was a devaluation of the currency made during 1991. I was a first year. I think I was about to complete my first master's in economics at that time, or maybe I was studying at that time. That was a time when I heard that there is a 10% devaluation of the Indian rupee. Since then, I haven't heard in India. So I'm sure that it's a very rare situation, very, very rare situation. Okay, so this is all about the two extreme cases when we have the absolutely no chance to move away because supply of money is so limited. It's so much tied to the precious currencies or the precious metals, or there's absolute freedom. But the reality is somewhat in between, or the reality should be somewhat in between. That we will discuss when we have a, should I give you a break at noon? Lunch at noon, yeah? And we can have a short, maybe 10 minutes break, quick coffee break. And we start at, let's say, 55, and then we spend 1 hour about this discussion, okay? So we'll be back at 55. And in the normal course of life, it stays. It stays. That's the way it is. Look, you need to be very careful about the context. When I say managed dirty float exchange rate system, it's a bad word, but it doesn't mean that these are two different things. This is like no discipline, no control, no check. I mean, the movement can be anything and in any direction limitlessly. But the reality is that it's not like that. The state is also, even though the state is not a player, but it still can be play the role of a referee. And whenever it thinks that things are going out of hand, then the state can also do some interjections if things are getting worse, not so good. I think this slide, I explain everything. The managed float is that in the good times, things are going the way we did in the previous, before the break section, that it can be in any direction, demand, supply. But here, what happened is that the state or the monetary authority or the top apex financial institute, the organization in the country, it sets a bar. It sets a bar and it sets a floor where the exchange rate can or must not rise beyond from and must not fall below this floor. So there is a cap and there is a, I can't call it socks, but let's call it floor. The upper limit, there's a lower limit. And in between, the demand, let's say for pounds, and let's say supply for pounds. So here the equilibrium is, let's say here the pound is for $1.20, and the state doesn't have to declare it publicly. It doesn't have to become like a big media news. It's an understanding between the market makers and the state that, you know what, even if the pound appreciates or dollar depreciates and it touches 1.40, up to 1.40, the state says, I will not interfere. Let the market forces play the role. And on the other hand, if the rate falls, if the dollar appreciates or the pound depreciates to the lower limit, 110, the state says, I will not care much in the and let the things go decided by the market forces. So it's like you said the rule of the game, football pitch, that okay, you can have, but if you're violating the rule, here the violation is if it tries to go beyond 140 or if it tries to fall below 110, then the state says, then I would come and interfere. And again, this interference is not with a big bang. No, it doesn't like that. The state just comes and start doing the correction measures. So it's a very soft action. It's not like you are clashing with the market. No, the state comes and does the fine tuning. For example, let's say, the central bank in the US feels that pound is becoming expensive, appreciation. And the one reason is that there is a lot of appreciation of pound is becoming expensive because the pound is not available in the market. Why something become expensive when it's short of supply? Yeah. And then the state decides that, you know what, we have a treasury of pounds. Let's sell them in the market. And what they do? The state sells pound. Which state sells? The US state gets some pound from the central bank and they throw in the open market. When you supply something in the open market, what would happen? The price goes down, and ultimately the price starts going down. Similarly, if pound value is going down in the American market, the one reason could be that pound is too much available in the money. So now we need a Hoover to suck extra, do this extra suction of pound from the market. And then the state, what they do? They start buying. The state becomes the buyer. And it picks up a bulk of pounds from the market. And when there's less supply of pound, the pound price will go up. So the state can do the fine tuning without nudging, without hitting, without kicking anybody, without causing too much of damages in the market. The state can also start playing not purely like a referee, but somewhat like a player also. So here the state is a referee when it sees that things are going out of hand, it is indiscipline, and then the state can also act as a player, buyer of pounds, seller of pounds, so on and so forth. So partially, state becomes a player as well. When I say state, it doesn't have to be the ministry. It's like those autonomous bodies like central bank or any other appropriate agency of the state. Usually the banks, they are the active players, the state banks basically. So this is called managed float, or we also call it dirty float, because here the state can be doing two roles. So it's a dirty thing that you are a rule maker and you are a player as well. So that's why we use this phrase dirty float as well. But more likely, more often we call it managed float. Managed float. The float is not fully free. Within this range, the market forces can go up and down. You see my point? But not beyond the limit, not beyond this. So it's not an indefinite freedom. So there has to be some checks and balances. But usually in the normal course of time, things go as per the flexible or the floating exchange rate. So yeah, that's everything about managed float. The last one is called pegged exchange rate system. Pegged exchange rate system is that you are training the gun on somebody else's shoulder by putting on somebody else's shoulder. You see my point? That you want to hit the target, but you don't put the gun on your own shoulder, but you put on somebody else's shoulder and then you target it. So let me give you an example. During 50s and 60s, there were many newly independent South American, Central American countries They were no more than some tiny mini islands. They were not having expertise to manage their own currency. They didn't have the expertise. So what they did, they decided that we fix our rate of exchange vis-a-vis American dollar. So we do some starting exercise. We can even invite some American economists to our island. They can do the holidaying in our nice beaches. But if they're free, we can also discuss that. What do you think should be the rate of exchange between American dollar and the Bahamas currency, for example? And then they say that, okay, let's fix some rate, some arbitrary rate, and let that rate be $1 American with some, let's say, some Jamaican, I can create some new sign, 8 Jamaican dollar or whatever is 8. Let's say the starting point. If in the market, American dollar goes up, the value goes up, then by default, the value of the Jamaican dollar also goes up against the other currencies. You see your point? Let's say, okay, let me give you more concrete example. American dollar 1 is pegged against the Jamaican dollar, let's say 8. Now, the American dollar against Canadian dollar is 1.20. Then I can say that this is pegged, this remains same. This will never change. I mean, until the new negotiations. So this is pegged. And in the real market, outside in the global market, the dollar is selling for Canadian dollar 1.20. Then by this peg, a Canadian dollar 1 will be equal to, if I divide 8 by 120, it should be, if you trust my calculation, then it should be 6.67. Look, Jamaican Monetary Authority are able to create an exchange rate against Canadian dollar without their currency being in circulation because they're too small to participate in the global financial markets, simply by pegging against the American dollar. Now, next time, if dollar appreciates and becomes equal to CAD 1.60, guess what? Then Jamaican dollar will also appreciate. How? 8 divided by 1.60, 5. Is there a point? Yes or no? The starting point is the pegging, that you fix your currency's value without caring about demand, supply, how much gold, whatever you have, just peg yourself. And make a declaration in the global markets that we have pegged our local currency against some hard currency, most likely. It depends upon your political and geographical proximity also. If you are living in, let's say, in Central America or South America, then the biggest economic power next door is America, the USA. Yeah. Maybe if you are close to some China currently, you can even peg against Chinese currency and so on and so forth. So this way, you find some peg usually you peg your currency against that country which you have a political, geographical proximity, and also bulk of your trade is with that country. And you want to rest yourself, assured, and without bothering your monetary authority. You don't have to have any top economist working in Jamaica, because now you have put basically all the burden on the shoulder of the USA, and that's it. You just merge yourself with. But sorry, yeah, it's an agreement with the country. Usually it doesn't last for very long, because soon your convenience become inconvenience. Imagine American dollar is losing against the major currencies later on. Then, okay, America is so big economy that it can even bear those shocks. But then when the things go wrong for Jamaica, they will not be able to bear this shock. If the US dollar is going down, is going really doing bad, then obviously that would also affect the Jamaican economy, the currency. USA is still resourceful that it can manage that shock, but maybe the Jamaican economy is not so strong too. So ultimately you have to give up the peg or revise the peg. Okay, and by the time when it's done, usually in the initial stage when the country is developing or evolving, this cannot be a mechanism for the rest of the country, rest of the life. So sooner or later you have to give it up. But this could be a good starting point for the newly developing countries, that they can peg themselves against. You can peg against one value, or you can create an average index value of some multiple currencies and then peg against them. You can also have the multiple pegging. So pegging is one, but against multiple currencies. We call it composite exchange rate. So you can peg yourself against composite exchange rate rather than one exchange rate. Okay, but this used to be very much in fashion during 60s and 70s, when newly after colonialism, many countries in Asia, in Africa, in Latin America were becoming independent, and they were not having capacity to manage their economic affairs. So then they were doing this pegging by inviting some experts and do. So all you need to do is to do the initial exercise. Rest all becomes automatic. Make sense? So here you see that when dollar is against a Canadian dollar 1.20, and because dollar is against Jamaican dollar 8, so by dividing 8 with 1.20, you can create an exchange rate between the Canadian dollar and Jamaican dollar at 6.67, because 8 divided by 1.20 is 6.67, yeah. And if dollar becomes stronger against Canadian dollar, then by default, Jamaican dollar also becomes stronger against Canadian dollar from 8 to 5. Pegging, well, the disadvantage is that you become too, well, first of all, the country become lazy. You don't think of developing. If the things are going good, you don't feel the need of making any change. But the problem is that when eventually things start turning bad, let's say now at some stage, the American dollar is depreciating against the Canadian dollar, then by default, Jamaican dollar will also depreciate against the Canadian dollar. This can cause some trouble. And if it happens against Canadian dollar, against other countries' currencies, so then you start feeling the pain, and then you say, hey, you know what? We need to give up. So there is too much of dependence.
What are the laws of the United States?
Look, actually, there's nothing happening to the US. In this case, whatever happens to Jamaica, because they are mirroring themselves in the shadow of the USA. Look, You don't even have to tell USA that we have pegged against you. Maybe some wise people in Jamaica, they sit together and they say, hey, from tomorrow onwards, we decide that, you know what, 8 Jamaican dollar against 1 American dollar. Simple. You can, yeah. But as I said, this solution doesn't last for very long. It's like, what is the phrase in English we say? The fair weather friend. If things go well, you like it. But the moment things go wrong, you say, sorry, we can't. Yeah. So then you either give up the peg or you have to revise the peg. Refill the peg. Daniel?
Is an additional vulnerability to the internet, like to the state of the economy of the company.
Yeah.
Well, of the country, because well, you're just stick to the one country which you can control.
Exactly.
And you also, I believe you also as a company have to have significant supply of the currency you depend on.
Significant what?
Amount of currency you depend on. Because you need to finance all this.
Yeah, that's true. Yeah, that's right. Ivan is very right when he says that there's a significant amount of currency will be involved in moving. Yeah, that's fine. I want to ask you something now. Let's say euro appreciation, and we can say against USD. Let's say we can take one concrete example, and then euro depreciation against USD. My question to you is, which you don't need to answer me promptly, you can take some time and do the mind mapping. What are the advantages and disadvantages of euro appreciating against USD and euro depreciating against USD? What are the good things? What are the bad things? So basically, I'm asking you that in this example, when pound was becoming overly appreciated against USD or overly depreciated against USD, what were the worries? What were the worries of the America, the USA, that they have to bring a control? Where is the control? That they have to bring this control, discipline. You see my point? What was wrong if what was problem if pound appreciates indefinitely against USD, or if pound depreciates indefinitely against USD? What were the troubles to the American economy that they have to bring a discipline that, hey, you know what? The maximum limit where the pound can go up is 140, and the lower limit to which pound can go down is 1.10. Anything above 140, anything above 10 would be state control. So what were the advantages and disadvantages of a country's currency appreciating against the other or depreciating against the other? Think a little bit more, and then we discuss.
I was talking about the floating exchange rate system or peg.
No, we're talking in general.
In general.
Question is not pegging or this or that. These are the outcomes. But the problem is that why we get worried if there is some country's currency becoming too much appreciated or depreciated. What is the impact on us? Sorry. No. Because here I say, what if euro? Let me rephrase it. What are the effects let's say, effects on Finland or Finland economy, Finnish economy, if number one, if actually, if euro, number one, appreciate against USD, and number two, depreciate against USD.
When it's depreciated, you have to slow down the trade.
I still think that you should take some time and think more, much bigger. See the bigger picture. Yeah. So don't be in a rush. I want to give you 5 minutes at least to think over it. And
Like a chain.
like a chain.
Like a chain, like there's a sequence of one change.
Yeah. So that's the problem, that you're definitely, as you said, that the exports will go up, because earlier for £1 of export, let's say you are getting 1.30 euros. And now with the depreciated euro or appreciated pound, you may get 1.60. So the Finnish exporters are super happy. For doing nothing, they are getting 30 cents more for each export of £1. But on the other hand, the importers are angry because now they have to pay more. So you have to please both masters. And secondly, as I said, that here, that the exporter would be happy is depending upon your assumption that the production system is flexible and there are resources available. But if your production system is so much exhausted that you have to withdraw resources from somewhere else to please the exporters, then what happens? That if this is the price in the market and this is the level of employment in the country, then the cost will go up, supply curve will go up, and as a result, the price will increase and employment will fall. And this could be called stagflation, which is having the worst of both inflation and recession. So therefore, touch this depreciation and appreciation as a mantra to earn more very carefully. Okay. All right, so we move on. And very quickly, we move on to the remaining slides of this topic. I want to take you to very quickly through, I will not go too much and discuss about these, but because these are very explanatory slides. What type of international financial markets you can approach? As a company based in Finland, if you are planning to increase your operations in Finland or abroad, you can use many options in the international financial markets. After you know the exchange rates and the impact and so on and so forth, now you can think which market is more suitable for you. The first kind of market which you can go in is called foreign bond market. First of all, bond is a debt. Bond is a debt, and bond is for the long period, okay? And long period means 365 days and above. It's a part of the domestic market where bonds are issued by a foreign entity. So imagine a Finnish company is going to start its operations in Malaysia. Then instead of moving money from Finland to Malaysia and going through those exchange rate fluctuations, they start issuing bonds in Malaysia to the Malaysian individuals and the Malaysian companies. And those bonds would be denominated in Malaysian ringgit. You see see the point? They're not in euros. They are denominated in ringgit, but they're issued by the Finnish company. So remember the documents I was talking about, corporate papers, CPs? The CPs can be issued by a Finnish company in Malaysia in Malaysian ringgit. If they do it, then they are called, it means that now we are talking about the foreign bond market. So now this Finnish company is raising funds in the foreign bond market. And often they have very funny names. Like, for example, we have this Yankee bonds, or we have this samurai bond named after the country, and we have the bulldog bonds. Matilda is Australian concept about the swag, the beautiful woman swag, Matilda. And maple, any hints needed? Canadian. What if it is Finnish bond? What name would you give it to? Huh? Licorice. Or what about Karu? Karhu bond. I would name it Karhu bond because it's so strong, a symbol of Finland. Yeah. So yeah. So try just to remember that the foreign bond market is very active rather. It was not before 1970s, but things changed a lot in the US. All these inventions are done by actually the American thing that, you know what, don't, because so much of money is going away from America to Malaysia, for example, and they say, you know, stop. Okay, we have operations in Malaysia, but let's start raising money in ringgit than in dollars. So that's what we say, that the necessity is the mother of invention, or all the opportunities come from the crisis, that, you know, this way. Okay, then the second is that, again, these are types of foreign bonds, but you call it global bonds. So in this case, the Finnish company, what can they do is that instead of issuing the bonds in particular country's currency, let's say Thai baht bond or the ringgit bond or Singaporean dollar bond, because issuing in different countries' currencies is not very easy. So they can issue in some, let's say, third currency, let's say American dollar, and they start selling them in Malaysia, Singapore, Hong Kong, Thailand, and those local people or the local companies, they buy those bonds, but they pay to the Finnish company in American dollars. So then it's called global bond. Okay. You can also call them some variability, some variant is called equity bond. The equity bond is that you, whether it's a global bond or the foreign bond, you give the option to the investors that, you know what, after a certain time, you have the option to convert it to the equity. And this goes to the first lecture we had, that the companies can raise finances from debt and equity. Sometimes the investors are very hesitant to give you equity because the risk is enormous when they invest in the share capital. So what they do, they first start in the debt capital, they stay with you. Once they know you more and you give them the option, they can convert their bonds to the equity. Yeah. Another, another variation of the is called Euro bond. X country goes to the Y country market and start issuing the bonds in the Z currency. Finnish company goes to Malaysia, issues bond neither in euro nor in ringgit, but issues the bond in some, let's say, Australian dollars. Why? because in Malaysia or in Singapore, Australia is not far away. And Australia is very predominantly participating in those Southeast Asian financial markets. And then say, hey, you know what? People are aware of Australia. Australia is very common here, but euro is far away. So let's start issuing bonds in Australian dollars. Then it's called euro bond. And remember, euro doesn't mean the euro currency. You see my point? Here, euro means X country goes to Y country and issuing bond in the third country's currency, none of the two. And here the euro is the symbol of that third country's currency, but not the euro that we, because this was, kind of market was existing even before euro came in practice. So they can't change the name, so it's still called Eurobond market. And then we have the euro currency. Yeah. The euro currency basically is euro money because, as I said in the beginning, that there's lots of money available. The lots of dollars, particularly, are available in the outside the USA. So therefore, what people do, instead of getting the dollars from the USA, they can get those dollars from the banks which contain them. Let's say in Dubai, in Hong Kong, and these type of Frankfurt, these type of destinations. So basically, you are borrowing US dollars, but not from USA, not from the US companies, not from the US based people, but you are borrowing from the non-US based banks. That is called the euro currency, basically. It can be any other, I can also call, for example, that you are borrowing pounds, but not from Britain, not from the British financial markets, but let's say you are borrowing pounds from Hong Kong, a bank in Hong Kong. Then this will be called as euro currency market. Yep.
More expensive from the point of refinancing of these debts, because it's like from the point of the supply and demand, like there is not so much currency might be in the reserves of the other country.
No, this is what I said. Opposite to it, there could be a problem that there is a more supply outside the domestic.
If the countries maintaining their in this case it's like GDP in England. How can it be like the supply outside the country can be more?
Well, there are many subsidiaries of British companies which are outside of Britain, and they have the bank accounts in Britain in the British pounds. Okay. So the pounds, rather than they move to the headquarters, to the main parent company, they keep in those banks, and those banks can utilize them. This is less for the British pound, but it's so often, so common for the American dollars. There's so many American dollars are in the Gulf countries' banks and also in the other countries. Yeah.
Circulation outside of the US.
Yeah. And as a matter of fact, there was one stage when, if you want to, that was also one mistake by the American, the monetary authorities, that if you are moving money away from America to America, you're moving the money to the headquarters, the tax was very high. The tax was very high. So what American companies, what American multinational companies did, that instead of repatriating the profits back to the headquarters in Atlanta or in Georgia, they kept them outside USA. Because over there, things were far more easier. You can even keep the money in Panama or in some
offshore.
Solomon Island or, Cyprus or whatever. Yeah. Yes, Ivan?
Is it tough as a central bank to control your currency when it circulates all over the world?
Yeah, but the central bank cannot demand from the other banks. Central bank is your country's bank, right? It cannot ask the other country's banks to move all the money back to it.
It's really tough to control the exchange rates.
Yeah, that is why it's not that every policy or every action of the central bank would be successful, because you don't have control over it.
Probably I'm mistaken, but I read that China doesn't want yuan to become the world currency because
It would never want it.
because it would be much more difficult to control.
The beauty of the USA was that despite all how much we criticize, there is some kind of inherent transparency and flexibility associated with the USA, which may not be found in other countries. So maybe they can't even. It's a very burdensome when you're, as I said, that sometimes your success is your biggest enemy. That if you are a kind of one big economy and you're leading the world, there is so much of extra pressure on you, right? US has done successfully for many, many, many years, I would say. If it was some other country, it would never been possible, Yeah, and some other variants. And yeah. Task 6, please listen carefully before you go for the break. Calculate the exchange rate fluctuations of US dollars, pound sterling, Canadian dollars, Japanese yen, and Australian dollar against euro for 1 year period, and draw the interpretations and get some inferences. Okay. When we come back after the break, I will explain you a little bit more about the weighted average cost of capital, because there was some question that where the data for WSEC come from. So first of all, I would discuss that. So basically, I would show you the spreadsheet of which I shared with you. Plus, maybe I'll take Finnair as an example, and then I show you how Finnair can calculate its weighted average cost of capital. And then I would explain one example template, which I uploaded already in Moodle about task 6. And then we will do one small topic, how if we know that we are exposed to exchange rate fluctuations, it can be appreciating, it can be depreciating, how we can manage it efficiently. But there are many ways to do it, but we would only discuss one way to do it. Okay, that would be called the currency forward trading. That we shall do in the class. So then that'll be everything for this course. Yeah. So enjoy your lunch. And what time we come back? It's 5 to noon. Is 1:45 okay? So we have 50 minutes break for your lunch. So we resume at 1:45. Thank you very much.
Okay, thank you.
Chat. Thank you very much. Yeah. Thinking. Okay. Thanks, Alexander. You wrote very well. Okay. So enjoy your lunch and see you soon.
Yeah, see you soon.
Thank you. Bye-bye.